Good afternoon, everybody, and welcome to this edition of Ask the Experts for Wednesday, March the 3rd. My name is Carl Capilingua. I'm the market analyst over here at Think Markets. It is a pleasure to be with you as we really throw the floor open to you and see what you'd like to talk about. I'm happy to give you a fundamental and a technical on all the stocks you're interested in, or it could be a commodity or a cryptocurrency. Anything at all. Before we do that, we'll talk about the Think Markets difference, which is substantial $8 flat rate trades, your own holder identification number. Make sure your broker has that for you. Unlimited phone support, of course, no hidden platform or subscription fees for fantastic reasons to make sure your next ASX share trade is with us. Okay, now Ask the Experts just as a bit of a background. It's a fairly new concept. It hasn't been tried or tested all that much over here, so we're still have our training wheels on. But as I suggested before, happy to have a look at the stocks you're interested in. So throwing over to you, Young. What stocks are you interested in at the moment? Zip. Good one. Okay. Yes, I've got you, Young. I can hear you. Okay. Yeah, look, great question, and certainly a sector that is very, very hot at the moment. I actually have on my watch list here, I've got a watch list with the buy now, pay later stocks on them. So perhaps we can have a look at the sector more broadly. You've mentioned Afterpay, you've mentioned Zip. I don't think I've got a favourite necessarily amongst that group, but we can certainly look at the charts of each and the fundamentals of each. Just looking at the Zip chart now, obviously I like to find stocks that are trading in uptrends. If a stock is in an uptrend, it means that there's more demand and supply over the period of time that I'm looking at. So I might look at a short-term, a medium-term or a long-term uptrend. And more demand than supply means, more buyers than sellers at any point in time. People who you would expect have done their research, made a rational decision about investing. So more people are looking to invest and fewer people looking to supply. So we certainly see a short-term uptrend on the chart. That's the light green zone through here. And the long-term trend is very much intact after having a very good rally from those 2020 lows. That's the overall trends. I'd also like to see higher peaks and higher troughs. So what that looks like on the chart is a sort of price action that looks like these upward A shapes and upward V shapes as we go. I'm not sure we're seeing that necessarily on Zip. If I zoom in a little bit now on the chart and we start drawing in these lines, we can see quite a clear cut price action downtrend. We don't know where this next swing is going to end until we get a movement back up, so that could end in anywhere. We'll leave that off at this point in time. So to see Zip as a buy for me, Young, I would prefer and now this is predicting the future and we don't know what's going to happen, but if we saw something like where it is now, if we started to see it come up and make these higher peaks and troughs, that would give me a better indication that the demand is starting to build in here, right? Because at the moment, I think we've got a bit more supply than demand. So until we see this, I can't get more excited. It's good that we've pulled back to this area of support. We do find that is an area of support from the past. So you can see how prices tend to bounce off that zone when we get in there. Okay, and we're in that zone now. Does it happen all the time? Sometimes it doesn't happen. So that's why we look for the confirmation in the price action. So check on the short-term trend, it's up. Long-term trend is up, check. Where we don't have the confirmation yet is in that price action starting to move back to the upside. So look, it's not a no, it's just a wait a little bit longer on Zip at this stage. What we might want to do, you mentioned Zip versus Afterpay, so we can certainly do a comparison there and have a look at some of the fundamentals on the company. So I like to, obviously try and find a company that has good value in it as well as obviously a good chart. So what we're looking at here are these are Thomson Reuters Icon. So Icon is the platform. I guess if you could say we had a Toyota Corolla, right? So Toyota is the company, Corolla is the model of the car. So Thomson Reuters is the company. It's a very big global stock market data provider, and Icon is the product that we're looking at here, and it pulls in various estimates of earnings, of profits and dividends and things like that from various brokers and collates them in one spot, and then I can grab that data and have a look at it. So we type in Zip up the top here and it goes and retrieves all of that data. So we're looking at some of the valuation numbers here. So we might start off by looking at its enterprise value to revenue, and that is, long story short, the value of the business versus the sales that the business makes. And we'd like to be having as much sales as we could get, and comparatively the smaller the business or the value of the business. So you're getting something cheaper for the amount of sales you're getting. So you can see that the forecast for FY21, so financial year 21, is 18.94, and then it falls down to 11.86 and 8.55. And that's quite a high number for any company, really. You do want to see that number falling. That would be a good sign. So the brokers are predicting that this number will come down, but it is a high number at this stage. We don't yet have a PE because the company's not making any money yet. It doesn't make a profit. So that is somewhat of a concern that we're not making profits yet. Now, these guys are heavily investing in their business at the moment to grow their business. So that's one reason why they're not making profits yet, but the question will become at some stage, look, when does that investment turn into enough growth to start to pay shareholders back for the risks that they're taking? So we're not forecasting a profit for Zip until financial year 2023, and that is potentially a problem because we've got a long lead out time. So yeah, no dividends and no profits for a few years. So that's interesting. If we look at what the brokers are saying on it, they are quite mixed actually. So we've got one strong buy, 3 buys, 3 holds, and 3 sells. Their mean profit target is 852. If we go back to the chart and we can put in 852 on the chart to see what the broker's average target is for the stock. So we simply click on this and we type in 8.52. So this is what the brokers think that the price target is for the next 12 months. And we can see that's considerably less than where the current price is at the moment. That's a little bit concerning for me. There is a high target of 1531. Maybe that's encouraging. If we have a look at some of the performance measures, so this is where the company, so it might sound a little bit scary, Zip, on everything I've talked about, but this is why these companies are in the news at the moment. They're getting a lot of attention is because we're looking at their revenue growth. So this is 2017, 18, 19, 20, 21, 22, 23. It doesn't look like revenue growth is very much at the start because it's coming off a very low base, but in percentage terms, these are very large increases. And then you can see massive expected growth coming through in revenues. That does translate into some gross profit, but gross profit doesn't include a lot of the standard running expenses for the business. It's literally what you sell and the direct costs in terms of selling it. So it doesn't translate necessarily into free cash flows, which you can see are predicted to be negative for a period of time, and it also doesn't flow into real profits that we can use as shareholders. So you can see EBITDA, which is earnings before interest, tax and depreciation and amortisation items, not expected to be materially positive really until FY23. Net profit after tax, once again, we're not expecting to make a profit until FY23 and therefore not having earnings per share until then. In terms of the ratios, enterprise value to revenue will come down, that's good. Price to free cash flow, not expecting to have any really until FY22, not expecting to have PEG or PE until then. Return on equity won't be positive for a while. So in terms of comparative ratings, so this is comparing the company to other companies within the top 500 companies within the ASX, and it doesn't rate necessarily very highly on those measures, mostly because it can't rate because of the lack of a profit at this stage. Really, I guess this exercise here, Young, is not to tell you to buy or not to tell you not to buy, but to give you as much information as I can give you to make your own decision as to what you'd like to do. If we compare Zip to Afterpay, might be worth having a look at that one now. Yes, I can go. So what do you think so far out of everything we've seen? It is popular, I agree, but yeah, I mean, I think you have to take that really long-term view because what we're seeing here, it's going to be, so we're in FY21, that ends at June 30. So really, we're not getting until another 2 years until this company starts to make any profits that we can start to get a feeling for what their trends are. Certainly, their revenue growth is amazing. That's fantastic, but it's hard to put a valuation on the company at this stage, and that's why it's a very volatile company. People are struggling to understand what the value is. What we can say is that if we look at the enterprise value to revenue, this is the way we can compare Afterpay and Zip. It certainly looks cheaper than Afterpay on that basis. So I don't know if you remember, but we were about 18 here and it fell to 11 here and about 9 here on these three numbers, Young, we're talking about. So on that basis, Zip looks cheaper than Afterpay. In terms of the brokers, I would say maybe the brokers are a little bit more positive on Afterpay than Zip, but there's not a lot else I think we can really compare on at this stage. It looks like we're expecting a profit on Afterpay before we're expecting a profit on Zip. And you mentioned before about the price. It's not so much the price. We can't say, well, Afterpay's $120 and therefore it's expensive, and Zip's $10 and therefore it's cheap. That's not really how the market works. The market's looking at those underlying numbers we talked about, and then based upon the number of shares on issue, then determining what the value of the company is. So you might find that Zip has more shares on issue, and therefore one of the reasons why Zip's having a lower share price than Afterpay. But look, just on that basis, there's certainly scope there for Zip to do a little bit of a catch-up. Again, I would caution against getting in while this trend is still down, but yeah, once it turns around, look, maybe there's a play there. It's not my they're not my favourite stocks simply from the fact that there's a long runway between them and making profits. But certainly, I do like to play momentum, and they have plenty of momentum. So let's compare it to something that makes a lot of money. All right. So let's have a look at Fortescue. Right. We know Fortescue is making a huge amount of money. Yeah, just to compare, right? So if we have a look at some of the numbers, so we had an enterprise value to revenue on Zip at 18 for FY21. It was 37 on Afterpay. So if you look at, so we want this number to be as low as possible, right? So if you look at Fortescue, it's 2.84. So it's it's roughly 1/10 of Zip. It's 1/20th of Afterpay, and then we start to fill in some of the blanks. So we have a price to earnings ratio. So you're paying 6 times. The price is 6 times the earnings of the company. So if you wait 6 years, the earnings that the company has made is fully paid for your investment in the company. So we can't even say what that is yet on Zip because it doesn't have any earnings. It's expected to be 200 times in FY23, I think it was off the top of my head. So you would have to wait 223 years for the earnings of the business to pay back your investment in the business. With Afterpay, I think it was forecast to be 1,200 or something, and then it comes down to, So there's a lot of things that can go wrong, and that's why I'm a little bit concerned about them. But the charts, the charts are the sum of all of the fears and all of the expectations, and the charts tell us what all the analysis comes up with. Now, some of the charts are spiced up a little bit by mums and dads getting involved, because mums and dads don't necessarily do the analysis that we do, and then have a good view of why to buy something before they buy something. Let's and that can move prices more than they should. Now, remember we looked at this. This is the comparison, right, for Fortescue versus the rest of the top 500 companies. So if you remember, Zip was 10%, 0, 0, 0, 0, 0, 10%, 10%, 0, 0, 0. So you compare it to Fortescue in terms of its enterprise value to revenue, it's better than 56% of the other companies out there. In terms of, for example, its price to earnings ratio, so how long it takes you to pay back your investment, it's better than 98% of the companies. So it's in the top 2% of companies on the stock market. Its dividend yield is in the top 1% of companies on the stock market. Its return on assets, return on equity. So this is management's ability to extract returns from their investment. It's better than 98% of the company. So if you average everything out, Fortescue is in the top 4% of all companies that really are worth looking at on the market. So Zip was down all the way down here. Fortescue's up here. I'm just comparing something that is very solid and very reliable, very low risk, to something that's significantly higher risk. Humm, good, okay, yes. Remember, we want to try and buy stocks that are in nice trends. So we want to see this long-term trend. Ideally, that one is heading up. And the shorter term trend here, ideally that is heading up. So this one, both of them are heading down, Bipin. I can't get too excited from the charts perspective, just at this stage. It is the least hyped of the buy now, pay later space, and they have a good business and they have a good reach, but it's more of an Australian-based story rather than Afterpay and Zip and Sezzle, who have major US and in some cases United Kingdom, Europe and Asian operations. But we can certainly look at it from the fundamentals. I think we'll find that the fundamentals are substantially more solid than the other two at this stage, but again, it might not have the growth that the other two has, and that's what the market's looking for at the moment. Yeah, well, the numbers on the face of it, the numbers from what I can see here actually look pretty good. So that's interesting that it's fallen so much. We're waiting for it to catch up. The PE is very healthy. The growth rate's very healthy. Dividend yield's not bad. Where it's failing here is a little bit on its return on equity, but otherwise the numbers aren't bad. It's in the top 20% of companies. Look, at the end of the day, you've got to understand that the market's doing this analysis as well, okay? And the market has better resources than you as an individual investor to do that analysis. The fundamentals are very hard because we only know so much. We only know what we know. We don't know what the rest of the market knows. So we look to the chart and we see if the chart is building demand, and we see lessening supply. We talk about supply and demand, right? So if you think a stock is fantastic, you will buy it. Number one, you'll want to buy it. You'll take some of your cash in reserve and you want to put it into that stock. Number two, if you already have the stock and you think it's fantastic, you're not going to sell, right? So think about what that does to supply. So if a stock is fantastic, there'll be very few people who want to sell it. So if people are in the stock and they think it's fantastic, they won't want to sell. And you've got to imagine there'll be very little supply of that stock around because people are holding on. At the same time, they've probably got cash they want to buy with, and there'll be lots of demand. So that's going to show itself up in the chart. And again, I know I keep going back to Fortescue, but it's just an easy example for me. When these lines, we're talking about this area here and this area here, when they're pointing, when they're green and they're pointing up, it's telling you that there's a higher probability that people who are in the stock, they don't want to sell, and people who have money, they want to buy. So, the thing you can do to keep yourself safest in the market is try and find stocks that are already showing this and this. Okay, that's the first starting point. So Zip, the good news is Zip is we've got the starting point. We've got people who own the stock, they don't want to sell it. People who have money, they want to buy it. That's a good start. But within these zones, we then need to look for those patterns that I talked about. These where if it's coming down, we stay away. When it starts to build up again, that's when we start to get involved. So that's all I'm saying on Zip. I looked at the fundamentals for you. I can't see a great deal of information out there because it's a fairly new company with new profits. So there's not much information to go on, and that increases the risks. Straight away, that increases the risk, but the reward is greater too. And that's what the market's all about. Because of the great growth that's coming through, you don't get any free lunches. Yes, there's great returns that can be had, but that comes with risk. If something goes wrong for Zip, if Afterpay is the model that people like and people stop using Zip, or if PayPal comes in, or MasterCard comes in, or Visa comes in, or the regulators shut it down, that's the risk that you run, okay? The upside is the growth is amazing, 100%, 200%, in users, for example. But the market will tell us that. So I'll finish off here. The problem with Humm is if you look at Humm, and we talked about whether the market was really excited about this company, and the people who had it, were they really so excited they didn't want to sell it? The people who had money, were they so excited they were just falling over themselves to buy it? So into that announcement, what were we seeing on the trends? We weren't seeing great trends, were we? Here. We weren't seeing great trends. Okay, so you guys are buying, you're trying to understand the fundamentals, and the fundamentals are complex and difficult. What we can do, one step before that, is have a look at the chart and say, okay, well, this one is a bit sketchy. The people who have the stock, they're happy to get rid of it when they get the opportunity. That's not a good sign. They should be holding on to it. The people who have money, they don't look very enthusiastic, and they're not buying a lot of it. That's a problem. If we look at EOS, we talked about that one before. What can we say about the trends before the announcement? Were they good trends? They weren't great trends. So that is something we can use just as a quick filter. Doesn't take long to do. I've got the values you guys can put up on your charts. I don't know if you're using a charting package, but up here is the moving averages I use, and we can do a session. Maybe not now, we're out of time, but I can show you how to put those on your Thick Trader app, and you can watch them for yourself. I like to look at the chart first, and then look at the fundamentals second. Okay, let's finish off today's presentation by heading back to the slides. You can catch the recording of this presentation, of course, all of our other market news updates in our market news section of the website. You can follow me or the Think Market handles there on Twitter. We have a few upcoming events. Next week, we'll be hosting the 3 stocks with dividends and growth webinar, where I will attempt to do the impossible, find you 3 stocks that have dividends and growth. And then, of course, the next edition of Ask the Experts on the 17th, bring your portfolios, and on the 24th, how to create an investing plan. The disclaimer before I leave you says that the content of this presentation is general in nature. We are a regulated Australian broker, and we do have some products that could see you lose more than your deposits. So make sure you read this disclaimer carefully, and if you have any questions at all, please give us a call. Thanks for joining me today. Hopefully you got lots out of it. All the best for your trading. Until we catch up again, bye-bye for now.